Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, to better understand the overall market environment, what would it be and why? So here's my one chart for today, the Semiconductor ETF, ticker SMH. So the semiconductor index is one that I have always followed. I think of it as sort of a bellwether index. When the market's doing well, semiconductors tend to do well, and the opposite. When the market's struggling, semiconductors don't tend to do as well. However, over recent years, semiconductors have actually done very, very well. They've been good performance in both offense and defense, meaning they've done well in bull market phases and also in bear market phases. So it's a key group to watch to see if that relative performance, that overall long-term strength, can be maintained. The reason why I want to highlight it today is because it's a perfect example of what I would call a bearish momentum divergence or a bearish divergence. This is a situation where the price is going higher, but the momentum underlying that price rise is starting to wane a little bit. So higher prices, lower price momentum. This tends to be a later stage bull market indication, suggesting an exhaustion of buyers, the end of an uptrend. So I think it's a really important chart to watch right here to see if it's able to hold up and validate that bearish divergence or not. Let's look at the chart together. All right, so here's our one chart, the Semiconductor ETF, ticker SMH. Before we get to that, if you like this sort of analysis, looking at charts, thinking about investor behavior, decision-making, psychology, routines, and everything all and above, make sure you hit subscribe, check out the like button if you could, and put a comment below the video. Tell me what you think about this potential bearish divergence scenario for semiconductors. All right, so here we're looking at the Semiconductor ETF, SMH. Now we're looking at the last 2 years. Here at the top, we have the price of the ETF, the 50-day moving average, the 200-day moving average. In the middle panel, we have the relative strength index, the RSI, and at the bottom, the relative strength of the semiconductor index versus the S&P 500, or the ratio of the SMH versus the SPY. So the first thing that I hope you notice if you look at the chart is the bottom panel and how the relative strength line consistently goes up and to the right. What's fascinating about semiconductors and really more broadly about technology is that it's been a consistent outperformer. So it's been what I call good offense and good defense. This is a group overall that's done well during bull market phases. So if you look, from June to September, you can see overall the relative strength line going higher, especially in the fourth quarters when it really accelerated to the upside. But much of 2019, it also was performing well as well. So it wasn't just when the market pulled back that this group started to emerge like with other groups that was the case. But this is a group that was actually outperforming for the 6 months leading up to the market pullback, and actually held up just fine during the pullback phase in February and March of 2020. So overall, long-term outperformer, which is very meaningful. This is what I call a bellwether group, right? When this is doing well, it tends to be good for the overall economy because semiconductors are pretty much in anything. And so, these stocks doing well speaks to demand for products that people need, right? So what's interesting about this now is the bearish divergence, the higher highs in price, which I've indicated here at the top of the purple line, and the lower peaks in the RSI is what's called a bearish divergence or a bearish momentum divergence. What happens at the later stages of a bull market cycle is price continues to go higher and higher and higher. And eventually, when it gets toward the end of the move, there's less momentum. There's one more push higher, but less, anecdotally, less buyers are pushing it, or the way that pushing it higher. So the way you might want to think of it is less buying power, for example, right? As the price goes higher, there's more and more demand, but at some point, there's enough demand to push the price higher, but not enough to really increase the buying power to accelerate the trend higher. So this bearish divergence is sort of a classic topping pattern. On this chart, you can see another example of the bearish divergence, which is here at the end of December 2019 to the peak in February of 2020. Look at the RSI, and as the price is going higher, there's a negative divergence, right? A bearish divergence of lower highs in the momentum as the price is going higher. So it tends to be a classic topping pattern. So what does this mean? I think future textbooks on technical analysis are going to feature this exact chart for one of two reasons. Either it is the most perfect example of a I think it is a perfect example of a bearish divergence. The question is what actually happens next. Either it's an example of where this works beautifully and a price going higher to clearly higher highs on clearly lower momentum is a topping pattern. It's an indication of the end of the move. This is the end of the trend. The semiconductor ETF breaks down through its 50-day moving average, breaks down through its most recent swing low, which is around 225. That's the low from late January, completes this rotation from bull market phase to bear market phase, and it's a textbook example of a market top. Or it ends up being a perfect example of a failed divergence, where price is going higher on lower momentum, but the price continues higher anyways. When I think about price, when I think about charts, the number one question is always, what is the trend, right? Look at the highs and the lows. Is the price in an uptrend or downtrend? Everything else I bucket into a group of things called confirmation. Price is the most important thing. Confirmation tells you whether it validates or does not validate what you're seeing with price. So the most important thing for the semiconductor index is to continue to make higher highs, which it's been doing, continue to make higher lows, which it's been doing. This has been the trend overall with the S&P 500 as well, which has not broken down through its January low just yet. So overall, until proven otherwise, the trend is positive. So either this ends up being an example of a market top because the price breaks down and validates this top, or it's an indication of a failed divergence where the price continues to go higher, even in the face of a bearish divergence. Now, that last point points out one of the two common challenges with bearish divergences. And if this was a 100% accurate holy grail type of indicator, this would be a very easy chart. It tells you semiconductors are going to roll over. It's an easy sell, an easy short, whatever. It's certainly not that easy, as nothing seems to be in life, and certainly in investing. So two challenges, and I implied the first one, which is that not all bearish divergences actually result in a rollover in the price. Tesla is a perfect example of that. We think of the run in Tesla. You think of a stock that's continued, as people have talked about it being overvalued and, being in a euphoric rise, but it continues to go higher and higher. I'll point out this particular point, which is early to mid-December of 2020. We're looking at the last 1 year here. So if you look right here, we're looking sort of at early to mid December of 2020. You can see that there's actually a bit of a bearish divergence here. Higher highs in price, lower peaks in the RSI. If you look, the price didn't even pause. I mean, it paused for like 2 days and then just kept on going higher. So this can certainly happen. And the challenge you have with bearish divergences, you'll get a lot of false positives where the price goes higher on weaker momentum, but the price just continues higher. And so what you want to look for is if the price breaks above that high from the end of the divergence, that suggests that the trend is not done, that it's continuing to make higher highs and the trend is positive. This is a false divergence, right? It didn't actually play out. So one challenge you have is a potential, just a failed divergence. The price continues to go higher. The other thing is you can actually have multiple divergences right after another sequentially. And if you look back at that period I highlighted earlier on the semiconductor chart, you look at December 19 to January 20 to February 20, you can see that there's actually lower momentum on each one of those rises. So there was a first divergence from December to January on lower momentum, and there was a bit of a pullback to the 50-day moving average. Then there was another move higher and another bearish divergence, right? It was sort of you might call it a complex bearish divergence, I guess you could call it, but it's really just a series of divergences one after another. Each one of those is indicating weakening momentum. That's indicating later stage bull market phase. And again, when we stop going higher, and especially when we break down and validated it by a breakdown through the most recent swing low, that suggests a further downside potential. And that was before the February sell-off. So two things to keep in mind with the bearish divergence. They're not 100% accurate as most things in investing are not. So two things to pay attention to. Number one, a failed divergence. The way that you would discover that's the case is if we break above 260 on the SMH, that would tell you this is invalidated and that we're just going to continue to go higher most likely. The second thing would be on the lookout for a sequential bearish divergence where we have continued higher highs in price, continued lower peaks in momentum, but every one of those just continues to add to the bearish case if that's the case. Every time we go higher, if we get weaker momentum, that can't happen forever. At some point, we either need to change and the momentum starts to improve as new buyers come in, or it's a top and we no longer go higher in price, and that's what validates it. So this is why this is one of my one chart. I think it's a beautiful example of a bearish divergence. This will be a classic example for one of two reasons. Number one, it may be a failed divergence, as we just highlighted, where the price continues higher, in which case it's a reminder to not pay attention to all of them, or we validate this market top, this top in semiconductors by a break below the 50-day and a break below the most recent swing low around 225. And in this chart, that's the line in the sand I'll be looking for. SMH below 225 suggests much higher likelihood, higher risk of further downside. That's our one chart for today, the semiconductor index, and really highlighting the importance of bearish divergences and how to think about them, what to look for. If this sort of thinking about investor decision-making, investor behavior, and charting is of interest to you, make sure you hit subscribe, hit a like on the video, put a comment below, tell me what you think about this bearish divergence scenario. From everyone at Market Misbehavior, I'm Dave Keller. Take care. Talk to you soon.